Hey, this is Kevin, a CPA that does financial planning. Today I wanted to talk about the second part of a two-part series. So this is it on financial planning. Who are the heroes that we should follow in both financial planning and investment management? And so I am a financial planner. I'm also a tax CPA. Charlie is a financial planner, and we are both investment managers. And so we want to help people, real live people, actually create plans and add value, focusing on decision makings that add value to people's lives. So who are the people that we follow, and what's the data suggest about decision making in finances? So the part one was really talking about who are our heroes, and there are other heroes as well. I just gave you some of the heroes. Today we're going to talk about what are the data suggesting as far as especially the investment portion. Most of the financial planning is about simple math and then deciding, hey, do you want to do this or this, and looking at what's the possible versus the probable versus the attainable. So I don't know if there's any real science. I don't know if there's any real science in financial planning. I think it's about using math and using data and constructs and framing to discuss what you want to do. Then with investing, we do have some science, or probably evidence-based is a better way to put it. There's lots of different flavors of investing. Even the people that have done these studies have said there's no perfect way to invest in the future because the future never looks like the past did. But there are things that seem to be keep on showing up when you put your risk capital out there and you invest in things and you wait a long period of time. There are returns that seem to continue to show up. And one person that I follow, Weston Wellington, that's the name. Weston has said that there's almost no chance that you won't be successful as long as you continue the process and you don't quit on it and you don't change your mind mid-sentence because markets have changed or because it seems like things are different this time. So let's talk about what we can control here, because that's really the most important thing. Let markets work for you. If U.S. stocks have done 8, 9, 10% over long periods of time, why don't we get those returns? They're pretty good returns. Why don't we get returns in bonds of 4, 5, 6? Right now, probably more 2 or 3, but it'll go back to 4, 5, or 6. Why not get those returns? Consider expenses and turnover. The more you pay in expenses, the less you'll get as a return. And turnover is all about buying and selling. That creates friction. Creates a lot of friction buying and selling. And we can control how much we buy and sell through the vehicles that we use. Diversification means not just buying S&P 500 or buying 20 companies. What diversification is about buying large companies, the largest companies in America, the mid-sized companies, the smallest companies, which are still publicly traded, and I'll show you about the world in a second. But there is a lot of data that suggests the more things you own, you'll still get somewhat market returns, but you'll get a risk-adjusted return that's really quite good. And then the final thing, and this was all about the behavioral finance I was trying to show you last time. It doesn't matter what you do. If you change your mind 2 years into an investment plan, or you change your mind every year, the years that you do well, you say this is great. The years that you don't, you say this is dumb. And you changed your mind and you will lose. So the markets have rewarded long-term investors, and this is the Ibbotson chart, and I think it's one of the most overused charts that really has very little to do with our day-to-day lives, and that's because they go back so far, back before the Great Depression, and they show us that if you had $1, you would have $17,000 if you had small cap and $4,000 if you had large cap, and et cetera, et cetera. And the big issue with this is that this is not what the investment experience feels like. First of all, not many people have a future investment time period of, 90 years. Most of us don't have 90 years that we're going to invest in. And even if we did, these little blips are horrifying experiences. All these little blips were recessions and crashes, and oh my God, we woke up that day and there was another really big one in 2000, and then 2008. Oh my God, we woke up that day. So markets will, for the most part, give you a positive return as long as the world doesn't go bankrupt. Stocks will probably outperform bonds. But this chart just kind of shows that, hey, you're going to get wealthy. And in real time, this is not the way it feels. There's times when it feels like, oh my gosh, this is really stupid. We should just put it in the bank. There's a world of opportunities in equities. And this slide was done a few years ago. The U.S. had 49% of investments were in the United States. Now, this is not investing in the government. I know this is a political year, and oh my gosh, what if this, or this happens? This is American companies. There's large companies, there's mid companies, and small companies here. And so the U.S. is a great place to invest. The issue is that if you only invest in the U.S., you're missing a little bit less than half of the world opportunities in world markets. Now, China, if you notice, China is a very small player in investable markets. But of course, recently China has scared the world because of the amount of consumption that they have. But we advocate, again, because diversification works. It's the only free lunch, is to invest in world markets. There will be times that we will have a reference risk. And the reference risk is a behavioral finance issue where if you look at the S&P 500 every day and you look at the returns every year, and if your portfolio owns the world, there will be times when your portfolio will outperform the S&P 500, and there will be times when it does not. Again, as soon as you say I'm giving up on foreign or I'm giving up on small companies, that's usually when the returns show up. Bond markets. Now, the studies on bond markets suggest that, well, first of all, about 1/4 of all the bonds in the world are floated in the United States. And all a bond is that I give you money, you're the government, you pay me back interest, and then you pay me back my principal or corpus. What studies have shown in bond markets is that since we live in the United States and currency fluctuates up and down, that we should only invest in world bond markets if we have currency taken out of the mix. It's called hedging. And so for the most part, most of the bonds we invest in the world, and 3/4 of the market is outside the world, we hedge to the dollar so we don't have currency risk. Because if you're getting 2 or 3% a year and currency moves 2 to 3% in the other direction, it can destroy your return. Now, with equity returns, because they're higher, currency risk is not as big of a deal, and we don't take the cost of hedging, for the most part, world currencies. So Eugene Fama won the Nobel Prize in Economics a few years ago for his work in finance, basically. He's worked in finance, I think it's 54 years now. Again, one of my heroes, a very humble-looking guy. So what is this efficient market hypothesis? And, you know, why is it so important? Why is it something that's discussed? And you'll hear people say, oh, it's not efficient. Well, all it's saying is that today's prices, they may not be perfect, but they're about the best estimate of pricing. You know, when you look at, if you could have the dream team of investment professionals, if you could have Warren Buffett and Charlie Munger and Peter Lynch and Jack Bogle, anyone that you think is incredible, investment team, if you had all these people and you had all the smart people that are out there, the 80% of the people that trade every day that are professional money people, come from the best schools, if you could have this dream team and have them all, they're the market. And so the prices that are set by all these really smart people. Now, 15% of the trades are not done by these people. So part of it is the rest of us, I guess. But the prices are just the best guess. That doesn't mean that they're absolutely the best price and that prices are always correct. But all information, as soon as it comes out, as soon as Warren Buffett says, I'm going to buy Heinz, as soon as anything happens, bam, it's in the market. And by the time we go to click the button to trade something, the prices have already dropped and are already reflected in the market. Now, the things it does not include is that all investors are rational. Okay, it doesn't say that. It doesn't say prices are always right. Prices should be stable. And it definitely doesn't say that some money managers can't beat the market in short periods of time. But what it does say is that it's really hard to predictably and consistently go ahead and say that the prices in markets are wrong. So if you could do it consistently and you could say prices are wrong, they're too high, let's wait, prices are too low, let's buy, let's then sell when they get higher. If we could do this, then that would be great, but it can't consistently be done. So the majority of things you hear on TV are all about, somebody will say, I think this company, XYZ, is a great buy. I think XYZ is too high. I think you should invest in the sector of technology or this, that, or the other. This is all about sexy stuff that we feel like and we can talk to somebody at a party about. Forecasting, what's going to happen in the future? Well, it's an election year, therefore, blah, blah, blah. It's a good time to get out of the market. It's a good time to get into the market. This is all conventional wisdom, and it generates higher expenses to be buying and selling and trading costs. And it actually causes, more often than not, people cause things to be worse than they could be, and that's just accepting the market return. Now, why do we do this over and over and over again with conventional management? Well, we like to feel in control. We like to predict the future. We like to trust experts. All the evidence suggests these things are losers. They're the loser's game. You're going to do poorly. If you're trying to buy stocks, if you're picking a lot of stocks and buying them, for the most part, you are going to do worse than the same type of stocks that are out there. That's what the evidence shows. So this one is really incredible, this evidence. So some people say if you own 20 stocks, that's great. I have clients that have owned 20 stocks for a long time, and they said it's worked pretty well. Why would I want to sell them? Well, I think that's something that's an irrational behavior, because you've owned something for so long, it starts to feel like it's a part of you. Now, sometimes there's tax reasons why you want to sell them very strategically or tactically, but people want to hold the stocks that they've owned in the past because they start to really like them. And I do too, by the way. Stocks that I've purchased in the past, I never want to sell them. But here's the story. Since 1926, and I'm trying to find the mouse here. Here it is. All U.S. stocks have had a 9.9% return. Okay, that's that 10% return that we talked about. If you own everything, you get 10% return. If you exclude the top 10 performers, the highest 10% each year, if you take them out each year, you only have a 6.5% return each year. If you exclude the top 1/4 of the companies in America, you have a negative return. So it is the top 25% of the companies in a year since 1926 that have caused there to be great returns. So why would you put yourself in a position not to own the whole market? Because again, it's a small percentage of companies. How many companies this year, we're in March, are down tremendously this year because of all the market stress? And yet the S&P 500 is off a couple percentage points. Again, there's companies that do fantastic every year. We want to own them. There's world companies that do fantastic every year. We want to own all of them. It's not about owning only the winners. It's about owning everything so we have the winners. That's what the evidence suggests. So I'm going to post this slide. I'll send it along with this and I'll post it on the website. But these are the dimensions of expected returns owning stocks. And this is Fama and French's work. Own the market, tilt it towards small, tilt it towards value, have profitability. Let me show you the difference in returns in the past. Small's beaten large, value's beaten growth, profitability has helped. That's it. I'm out. Thanks so much for watching. Take a look at these premiums and look at the evidence, and we'll help you with evidence-based investing.